He is Matteo Regesta, interest rate strategist at BNP Paribas. Thank you very much indeed for joining us.
Good morning.
Was the ECB right not to let the markets know exactly what they might do if there is a crisis in Portugal or Spain?
Well, I think the ECB is very cautious because by giving the names of the bonds it purchases, it could attach stigma to the single entities it purchased. So that's why it's not disclosed. But at the same time, I think the compression we have seen over the past few sessions could prove temporary, as the S&P program is not the nuclear option as it was heralded by the press when it was first announced in May, shortly after the May press conference by the ECB, given its design and scale. And at the minimum, the ECB needs to add Spain to the bonds it purchased, because currently it only buys Ireland, Greece and Portugal. So it could prove temporary, the compression we are seeing.
And Tricia said central bank will keep offering banks as much funds as they want at a fixed interest rate for 7 days, 1 month, 3 months potentially through the first quarter. How much relief is that going to bring to the markets?
I don't think this is something which the market was not expecting. If you look at the forward EONIA curve, basically normalization, full exit, was not priced in, not even by the end of the next year. I mean, a strong sell-off would ensue if the exit would have been announced. But an extension of the current framework, I think, was pretty much what the market was actually expecting. I think the problem is more on bonds, and when it comes to liquidity, in the end, excess liquidity is a demand of banks. It's not really under control of the ECB. In terms of liquidity, I don't think we have a strong issue under the current framework, and in the end, what Tricia announced yesterday, what was the market was expecting, given the prices on the EONIA forward curve.
But is an extension of cheap money for the banks going to resolve the problem that we have right now, given ongoing concerns about banks becoming addicted to cheap money?
Well, it's going to buy some time, because as we stand, we need at least the EFSF facility to increase scale, given that we have strong issues in the banking sector, as you correctly mentioned. In fact, the stress tests that were passed in the summer have lost credibility after the Irish bailout, with the package actually assumed 35 billion for bank support only. We know that the Spanish banks can have problems, and the overall exposure of UK, Germany and France to the Spanish debt, both private and public, is around $450 billion, according to the Bank of National Settlement. So I think the liquidity for banks, particularly in certain regions, is a temporary measure which can definitely buy time, but going forward, without information about the real condition of balance sheets of Spanish banks, for instance, I think the volatility will stay high, and unless the EFSF facility is not scaled up, I think the relief we are witnessing in Euro periphery could really prove short-lived.